Imagine owning a supermarket during its busiest week of the year. The parking lot is full. Every checkout lane is open. Employees are replacing products almost as quickly as customers remove them. One cart reaches $214. The next reaches $287. By Sunday night, hundreds of thousands of dollars have passed through the registers. It looks like the perfect business. People have to eat. They return every week. Grocery prices keep rising. And the store is never empty. But here is the part customers never see. In 2025, the average U.S. supermarket generated roughly $668,000 in weekly sales, according to FMI. Yet the average food retailer's net profit was only 2.1%. Apply that margin to those sales and more than $668,000 becomes roughly $14,000 in profit. The store was full. The carts were expensive. The revenue was enormous. So where did the rest of the money go? To answer that, we have to follow the money from the moment it enters the register and watch almost all of it disappear. Before the first customer arrives. A supermarket is not simply a large room filled with shelves. The average American supermarket in 2025 was about 42,000 square feet and carried more than 33,000 different products. Each product needs a supplier barcode, shelf location, price, inventory count, and replenishment plan. Then come refrigeration systems, freezers, loading areas, bakery ovens, deli equipment, checkout machines, cameras, insurance, licenses, opening inventory, and enough working capital to pay employees before the store becomes stable. There is no honest universal startup figure. A leased neighborhood market and a ground-up full-service supermarket are completely different projects. But either can require millions, and investment never really stops. Albertsons spent about $1.84 billion on property, equipment, and technology in fiscal 2025, while completing 94 remodels and opening 9 stores. The owner spends heavily to fill the building with assets. And then many of those assets begin expiring. Follow $100 through the supermarket. Now take one customer's $100 grocery bill. Instead of inventing a universal breakdown, consider the latest full-year results from Albertsons as one real-world reference point. In fiscal 2025, Albertsons reported a gross margin of 27.2%. In simplified terms, for every $100 of revenue, roughly $72.80 had already been absorbed by the products and costs included in cost of sales. That left $27.20. But that was gross profit, not money the owner could take home. That remaining amount still had to support cashiers, stockers, managers, butchers, bakers, and cleaners. It had to cover stores, refrigeration, technology, security, insurance, maintenance, marketing, interest, and taxes. It also had to absorb products that spoiled, disappeared, or were counted incorrectly. Even accepting the customer's payment costs money. FMI has reported that credit and debit card fees can absorb the equivalent of roughly 1 percentage point from grocers' results. After adjusting Albertsons' fiscal 2025 earnings for major unusual items, the company kept about $1.21 billion from $83.2 billion in revenue. That is approximately $1.45 for every $100 of revenue. Albertsons is not every supermarket, and FMI's broader industry average was slightly higher at 2.1%. But both reveal the same gap. The customer sees $100 leaving their bank account. The supermarket may ultimately keep only around $1 to $2 of it. And groceries themselves make that equation even more difficult. Every product has a clock. Compare a television with a tray of strawberries. If the television does not sell today, it can probably wait until next week. The strawberries are becoming softer, less attractive, and less valuable by the hour. Milk has a date. Meat requires an unbroken cold chain. Seafood needs careful handling. Prepared meals may become unsellable by closing time. Frozen food consumes electricity every minute it remains in the store. EPA's Energy Star program says refrigeration can use up to 40% of a grocery property's total energy. The supermarket is therefore paying to stop part of its inventory from becoming worthless. And some products still never reach a paying customer. Shrink includes shoplifting and employee theft, but also damaged goods, expired food, scanning errors, vendor mistakes, and inaccurate inventory counts. Retailers measure it differently. so there is no reliable universal shrink percentage for every supermarket. But consider an illustrative store producing $50 million in annual sales at a 2% net margin. It expects to keep $1 million. If additional spoilage, theft, and mistakes consume just 1% of sales, $500,000 disappears, half the expected profit. 1 percentage point can separate an excellent year from a terrible one. The products that change the math. Basic groceries attract customers, but they often give the supermarket little room to differentiate itself. The same famous cereal, soda, or detergent may be available at every competing store, allowing shoppers to compare prices instantly. That is why supermarkets build bakeries, delis, floral counters, pharmacies, and walls of ready-to-eat meals. These departments can produce stronger gross margins, encourage additional visits, or give shoppers something they cannot buy in exactly the same form elsewhere. But higher gross margin does not guarantee profit. A deli also requires labor, packaging, food safety controls, and accurate demand forecasting. Prepare too much food, and the apparent margin ends up in the garbage. The more powerful solution is often private label. With a store brand, the retailer controls the product, packaging, price, and shelf position. Customers cannot compare the exact same item at a competitor because the competitor does not carry it. Across track U.S. outlets, store brands generated a record $282.8 billion in 2025. Their dollar share reached 21.3%, while sales grew 3.3%, almost 3 times the growth rate of national brands. The cheaper-looking product can therefore be more strategically valuable to the supermarket than the famous brand sitting beside it. But the shelf holding those products can also become a business. When the shelf becomes the product. An end cap is not merely a shelf at the end of an aisle. It is access to customer traffic. The checkout display is access to impulse. The first result inside a grocery app is access to purchase intent. Depending on the agreement, manufacturers may fund promotions, discounts, physical displays, or preferred digital placement. These arrangements differ across retailers and suppliers, but the underlying logic is powerful. The supermarket is not only selling products to shoppers. It can also sell brands better access to those shoppers. Loyalty programs make that access more valuable. A large retailer can see what customers search for, what they buy, and whether an advertisement produced a real purchase. Albertsons now reports media advertising revenue within its business. Kroger describes retail media as a high operating margin alternative profit business. The supermarket's most attractive product may no longer be something sitting on a shelf. It may be the shopper walking past it. Why a packed store can still lose. A busy store is not necessarily a profitable store. It may be crowded with customers buying promoted milk, discounted staples, and famous brands priced aggressively to match a competitor. Meanwhile, overtime is rising, a freezer requires repair, and prepared meals are approaching closing time unsold. The owner does not merely need traffic. The store needs the correct combination of basket size, product mix, labor hours, inventory turnover, and operating costs. Even inflation creates a misleading picture. In July 2026, U.S. grocery prices were 2.7% higher than a year earlier. That can increase the dollar value of sales without increasing profit. If wholesale beef rises faster than the store can raise its meat prices, revenue climbs while the margin contracts. Deflation creates the opposite problem. The store may sell the same number of products at lower prices while rent, wages, and refrigeration remain largely unchanged. This is why management obsesses over tiny percentages. At a hypothetical 2% net margin, a 2-point increase in costs does not reduce profit slightly. It eliminates it. The online grocery trap. Online grocery appears more attractive at first. FMI says the average online supermarket transaction in 2025 was about $106 compared with roughly $49 in-store. Online purchases also represented 8.9% of grocery item sales. The digital basket is larger, but the customer has transferred work back to the supermarket. Someone must walk the aisles, inspect produce, manage substitutions, bag the order, protect frozen products, and either stage everything for pickup or deliver it to the customer. Albertsons' digital sales grew 21% in fiscal 2025. Yet the company also said higher delivery and handling costs contributed to a lower gross margin rate. More revenue did not automatically create better economics. Kroger reported a significant milestone in the first quarter of 2026. Its e-commerce operation, including media, was profitable. But those final two words matter. Including media. The profitability of selling advertising around an online order can help support the expensive work of fulfilling that order. This is why delivery fees, memberships, automation, and retail media are becoming connected parts of the same strategy. Supermarkets keep investing because customers increasingly expect convenience. Refusing to offer it may protect the margin on one order while losing the customer's entire weekly basket. Scale is the advantage and the danger. Large chains can negotiate better purchasing agreements, operate distribution centers, spread technology costs across thousands of stores, and build private label portfolios that independent operators cannot easily replicate. Save 1 cent on a product sold a few hundred times, and almost nothing changes. Save 1 cent across billions of items, and the result becomes enormous. Scale also creates the data and audience required for retailer advertising. This gives large chains another profit layer the single supermarket may never develop. But scale makes mistakes enormous too. Kroger recorded roughly $2.5 billion in impairment and related charges in fiscal 2025 after changing its automated fulfillment network. That was an unusual company-specific charge, not a normal supermarket cost. But it shows the danger clearly. The same scale that turns tiny efficiencies into billions can turn one mistaken logistics strategy into a multi-billion-dollar loss. So why own a supermarket? Because low margin does not automatically mean bad business. Food demand repeats. Customers may return several times each week. A strong location can generate durable traffic, and well-managed inventory converts back into cash quickly. Private label improves differentiation. Prepared food expands the basket. Pharmacy can increase visits. Loyalty programs deepen the customer relationship. Retail media creates a higher margin layer above the physical store. And a tiny percentage of enormous sales is still substantial money. But different models produce different results. Costco, for example, generated $269.9 billion in merchandise sales, $5.3 billion in membership fees, and $8.1 billion in net income during fiscal 2025. Membership fees are not identical to profit, but they provide an income stream conventional supermarkets do not have. Costco, therefore, should not be treated as an ordinary grocery store. For a traditional supermarket, success depends on volume multiplied by a tiny margin and extraordinary control over everything that tries to consume that margin. That means one better purchasing contract, one fewer wasted pallet, one more private label sale, one more profitable customer visit. The store can process tens of millions of dollars and still be only a few mistakes away from losing money. The money was never really yours. So why can a full supermarket barely make money? Because it is not simply buying food cheaply and selling it for more. It is operating a refrigerated warehouse, restaurant, retail store, logistics network, technology platform, and food safety system at the same time, while customers compare its prices with competitors in seconds. Most of the money belongs to someone else almost as soon as it enters the register. A supermarket does not become powerful by making a fortune from each cart. It becomes powerful by moving a fortune through the building, keeping $1 or $2 from every 100, and repeating that process millions of times without allowing those final dollars to disappear.